All right. If you're looking for some advanced strategies, selling income property and deferring your taxes, then you definitely want to check out what we're going to talk about here today. My name is Ben Larson. I'm here with Engel and Volker's Realty. And today I want to talk, if you own income property, we're going to talk about some tax deferment strategies. And, you all may have heard of a 1031 exchange. If you own investment property, you probably have. I know property owners that haven't heard of it, and that's perfectly fine too. But I want to get into a few strategies today, and some really they're alternatives to a 1031 because a lot of people own property and they just kind of get tired of it eventually. Maybe been doing it a long time, or it's been a challenging time with COVID. We've had all that we've been dealing with. So I just wanted to get into a little bit what might be some alternatives for you. And obviously the 1031 exchange is one route of tax deferment, but to do that, you typically have to go buy another property and continue being a landlord. It's not always the case. We'll talk a little bit about times that it's not, which is a benefit. So we've got that. And then there are Delaware statutory trusts. We've got opportunity zones. And then a new one that I heard about recently is a 721 UpREIT. REITs are real estate investment trusts, usually bigger investments. And this is a way to exchange into something like that. So I'm going to talk a little bit about that today too. All right, I've got some notes here, so I'm going to go through those just to make sure I don't miss anything. First, I'm going to touch on 1031 exchanges. And this is a tax deferred exchange where you own a property, you sell that property, you defer the taxes, and so you move all the gain over into purchasing a new property. And a lot of people get confused, or they think, it's got to be if I sell an apartment building, I got to buy an apartment building, or if I sell a house, I got to buy a house. It's really any investment property from one investment property to another, but it does have to be some type of investment property. You can't sell a primary residence and roll it into an investment, or sell an investment property and roll it into a primary residence. It just doesn't work like that. But that's what they mean when they say like kind. It's just an investment to an investment. The other thing a lot of people don't realize is the time frame of it. They may know, oh, I get 180 days. Some may not even know that, but you get 180 days to complete that purchase once you sell the other one. But what a lot of people don't realize, the tricky part of that is you have to identify the property you're going to buy within the first 45 days. So in a tight market like we're in now, and we've been in and out of for a while, depending on when you're watching this, if it is a tight market, you probably realize that could be tough to do. You sell something and you got to know what you're going to buy in 45 days. You actually can identify 3 of them, but I don't know what markets at the moment have 3 properties that I can go out and say, okay, I'm gonna buy one of those 3 in the next 45 days, and take your time to decide. You're basically going out, if there's one, you're making an offer and that's the one. But so that's a key thing to know about that as well. So there are other types of exchanges. A reverse exchange, you actually can buy the other property first. If you have the funds to put down, you can buy the second property. We call the second one the up leg, and the first one the down leg, because it's down here and you're moving up to the other one, even if it's, it might be smaller depending on where you're coming from, different areas. But the process, we call it the up leg. So that's a reverse is much more costly, more difficult to do, but sometimes, and especially in a tight market and tight time frames, if the right property comes along and you can purchase it and you've got the funds for the down payment to qualify and buy it, then that is a way to go. And it may actually be worth, a regular exchange is, $1,000 or so. Reverse exchange, just the cost of the exchange itself is probably $9 or $10 grand. And then there are usually some other costs that may come along with it. But if you have questions about that, reach out to me and I can put you in touch with a great 1031 accommodator and they can answer that for you. So 1031s is the first one. I want to go into Delaware statutory trust. So that's basically where you're investing if you've heard of a syndication. So that's where you're investing as one investor as part of a bigger investment. And the nice thing about this is it's very hands-off. But at the same time, the downside of it is that it's very hands-off. You don't have a lot of control. So you sell your duplex here in the South Bay, and maybe what you have, and then you exchange into this big office building. That's really not the best example these days because office buildings aren't really doing that great, but whatever it may be, or you invest in a Target or, an Amazon warehouse, something that, maybe doing a little bit better. And so you couldn't go buy that on your own, but it's a pretty solid long-term investment with decent returns. But you can exchange into it. You could take your little piece and you could do a 1031 exchange into that. And now you've got some passive income. It may not be quite what you had with your rental property. It might be close. It's usually a decent return. And some of the ones I'm seeing now are 5 or 6%. So it could be that. It could be, a 100-unit apartment building in the Midwest. Something like that you're going into with other people, and it's completely managed. It has property management, the managers for the investment itself making the decisions. It's all laid out in paperwork, in a general partnership or an LLC or something that details, here's what's going to happen, here's the holding period. All that's pretty well laid out. Things do vary a little bit, but that gives you kind of a sense of what you'd be getting in the Delaware Statutory Trust. So from there, then there is what's called a 721 UpREIT. And this is a little bit of a twist on REITs, which, is real estate investment trust where they own a bunch of different properties. So it's the same situation for an UpREIT, the 721, you can diversify because you're buying into a number of different properties, not just one. So if something happens to that property class or something happens to that, then you don't end up with just that, and the value goes down, something happens, then all your eggs are kind of in one basket in that case. So this UpREIT, which is a REIT, gives you a number of different properties in different sectors, and so it kind of diversifies your situation a little bit. So it is, again, very hands-off. So it's similar to the DST, the Delaware Statutory Trust. There is another DST, not to be confused with the Deferred Sales Trust. We're not going to talk about those today, but maybe we'll do a different video on that someday. But so this, you actually have more liquidity when you do a Delaware Statutory Trust. You're kind of tied into that in most cases. You may be able to sell your interest, but it's a little bit harder. When you go into the 721, you're actually buying into shares. So you could sell those shares, 10% of them here, 20% there, and you don't pay any of the capital gains until you sell those. So you defer the gain on that duplex that you own here in Redondo. You move that all over in there, and then it just grows. It's tax deferred, so the investment grows, and you're making money on the money you would have had to pay in taxes. So it's a benefit there. And then say, you don't have to sell your whole interest, everything you exchange into it. You might just want to, cash in a little bit. You just cash in some shares, and now you pay just on what you cashed in. So, 10% of it and whatever the taxes are on that, you cash that in, you get it back. So it gives you some flexibility that you don't with other types of these tax deferred options or alternatives. So that's the 721 UpREIT. Obviously, there's a lot more to it, and if that sounds like something that might fit your situation, or if any of this, always reach out. Reach out to me. We can set up a strategy session just to kind of brainstorm some of these. I can put you in touch with the people that run these types of programs. They're not going to pitch you on it. They're going to answer your questions and give you a lot of info on it, so you can really figure out what's the best fit for you. Another one I think is really interesting, we don't hear enough about, is opportunity zones. So what opportunity zones are is it's where their advantage is given to people investing in low income areas to try to develop and really improve those areas. And so they provide significant tax advantages for people that do that. So there's deferring the taxes, as well as, they may waive them altogether. So some of the advantages of opportunity zones is if you hold them if you invest in an opportunity zone and there's a map, you can find out where it is, and you can buy into, there's two ways you can go about it. You can just go buy an individual property there, or you can invest in a fund that buys there, and then you've got multiple properties, and again, you're diversified and your exposure is spread around a little bit more. You buy one property there, you're going to get the tax benefits, but again, if something happens with that sector or that type of property or that area, then you're going to be affected by that. So opportunity zones, but if you hold it for 10 years or more, those taxes that you deferred into it, if that's a regular 1031 exchange, those taxes are still sitting there. You go sell that property, you don't exchange it again, now you have to pay tax on that. You put it into an opportunity zone 10 years down the road, well, now those taxes are eliminated. So all those taxes you deferred, you now don't have to pay capital gains tax on it. And that's something I just want to plug for everything I'm talking about here. I am not a tax professional. I am just relaying information that I've heard, that I've experienced, that I've helped clients with. So I'm just giving you some overall general information. Everyone's situation is different. Talk to your legal and tax professionals to confirm how all of this may apply specifically to you. And things change. So depending on when you're seeing this, it may be different by the time you actually are watching it. But that's another really nice thing about opportunity zones is it doesn't just have to be investment property. So if you have a lot of capital gains on a home and you don't need to cash it all in right now, you can invest in one of these opportunity zones. And if you keep it in there long enough, you can then have the taxes, you can defer them while they're in there. If you keep it 10 years or more, well, then the capital gains will be eliminated. It can also be done on other investments. My understanding, I don't deal with this side of it, but it can be stocks and other type of investments like that as well. It doesn't even have to be real estate. So I thought that was really important. So some of the differences, I want to touch on some of that. Let me just go to my notes here. Sorry. So I wanted to show you, I'm going to pull up a slide here and show you kind of some of the a comparison of the different programs so you can get a sense. So 1031 exchange, I'm not going to read through everything, but I'll just give you an overview. So the tax strategy is deferring the taxes, management is active, diversification is low, you're just exchanging it over into another property. Cash flow can vary, the total return varies. The differentiator of that is that you have control. You want to sell it in 2 years, you sell it in 2 years, you want to hold it, then you hold it. You want to add an ADU to it, you add an ADU. You don't have to have that as a plan or have the group, be on board. Tax strategy for the DST and the UpREIT, same thing as deferring the volatility, is preservation and some cash flow as well. Leverage with the DST, you get some leverage with that. Buying into a big investment, the UpREIT, you're leveraging. When you leverage into it, you can leverage in with the investment, as a down payment. So you're leveraging in with financing. So leverage in real estate is, say for example, you buy $1 million property and you put 50% down. Well, you put 500,000 down. If that property doubles and goes up to 2 million, well, now you made $1 million on that 500,000. You didn't make a million on the million. So you're leveraging that money. Both of them are passive management, where all three of these with opportunity zone as well as passive. Diversification, DST is a little bit of diversification because you're going into a bigger property with other investors, a little more stable. With the UpREIT and the opportunity zone, it's high diversification because you're going into multiple properties, multiple sectors. You can see the holding periods. The 1031 exchange can be whatever you want. DST 5 to 7 years, the UpREIT 2 to 4 years, and then 10 years on the opportunity zone to eliminate. And that's what the opportunity zone, the tax strategy is deferment, but also potential elimination if you hold it long enough. Then you can see the cash flow. The DST is the lowest out of these other three. The UpREIT and the opportunity zone are very similar. And the total return, there's most of the upside is in an opportunity zone because a lot of those cases it's development. where you're improving the property and adding value. And so there is a higher return on the value that the property becomes. And it's also over time, there are areas that are purposely being improved. And so they do appreciate a little bit more than maybe areas where they're just natural appreciation. So the differentiator, it's probably a big part of it. Control is a 1031 exchange. Preservation is the DST. You just get into something safe, get a good return, and you just preserve those deferred taxes, preserve that investment. The UpREIT path to liquidity. So it's something like we talked about where you can sell those shares and you can actually liquidate part of it without having to exchange into another property or sell the whole thing, sell your whole interest like that. And then the opportunity zone, obviously the differentiator of that is eliminating the taxes and the development upside. That part of it is huge, I think, the development upside, but eliminating the taxes, that's something, especially, being able to do that with just about any type of investment, not just real estate related, is something that's not common and that a lot of people are looking for, they're not able to find. So again, I just want to make sure, questions on any of this, you can reach out to me. I can put you in touch with a professional. If you want to know how it pertains to your situation on the real estate side, I'm happy. I can analyze a property you have. I can help you look at what properties you might be looking to buy. If you're doing a normal exchange, I'd have to refer you to someone. I don't get anything off of the 721 UpREIT or the opportunity zones, or even DST typically. So I just am doing it as a service and an explanation for people that are looking for alternatives. I got clients that don't always want to move into another investment property that they're going to manage. And so I want to take care of them either way, even if I'm not the one that's going to be helping them buy it and representing them as their agents. So definitely reach out to professionals, tax professionals, legal professionals, to help analyze these situations and what might be best for you. And then, I appreciate you taking the time to watch this. Feel free to subscribe, turn on notifications, suggest this, pass this along, share it to anyone you think might be interested. I'm going to provide my contact info here on the screen, but I'll give it to you anyway. You can reach me at 310-400-0536. It's ben.larson@evrealestate.com is my email. So you can find me there. So lots to consider, but I love to have strategy sessions where we just brainstorm what might be the best route. And then, we figure some different avenues and come up with some things to look into for you to talk to your tax professionals, or just to explore what some of these other opportunities might look like. So that's all for today. Thanks a lot, and join us next time.